welcome all from Bloomberg Television. Jim Caron, good morning.
Hey, Tom, how are you?
Good. This is a tough time for any strategist. You have a call, you say enough, and you published with great clarity today your new leaf, Becoming More Tactical. Let's look back first. If you look back at the Berner, Greenlaw, Caron team, what did you just get wrong? What was the thing that surprised you is interest rates stayed low?
Well, the first thing that surprised us was just how much money stayed in the bond markets, and in fact didn't just stay in the bond market, but it accelerated towards the bond market. So, for example, if you look at the ICI data, we're at record-breaking pace of inflows into bond funds, over $190 billion this year, and the year's not even over, and we're already breaking a yearly record here. And what we had presumed was that with our first half call for our economics team, which was to have somewhere close to around 3% growth, which we did get reasonably correct. We thought that we would get a pretty decent upswing in the equity market, and then the money would flow out of the bond market, move into equities, and that would cheapen up bonds.
Oh, go ahead, Jim, please.
No, I was just going to say that it would then cheapen up bonds, and yields would then start to rise.
Right.
And in fact, that didn't happen. What the investor preference was in these uncertain times, and this is another point that we got wrong, was people just wanted to get their money back. They wanted to have the safety and liquidity of bonds more than take the risk of entering into a riskier asset like equity. And then, of course, the data started to turn. The European situation turned worse, and the data as it's shaping up as we even enter into the second half right now is looking worse. And then of course, there's the Fed, and that's another whole can of worms.
Yeah, well, you lay out here with great clarity 6 bullet points of what went wrong. Let's parse the distinction between bond fund flows and equity market flows. Was this about money moving to bond funds, or was it about money not moving to equity funds? If there's an asymmetry, which way does it go?
Well, it actually was mainly going towards bond funds, because what we saw in equity funds was mainly outflows throughout the entire time. In fact, if you go back over the past couple of years, we've seen steady outflows in equities for the most part, but for a few months where there were some inflows. But overall, it's been a steady pace of outflows. And, the bond market has had some very attractive returns. Last year, the corporate bond market was up around 18-19% year to date. Currently, right now, the Treasury market 10-year notes are up about 14% year to date. Bonds were where the return was.
But the key distinction, Jim Caron, is you're not getting on board the bond bulls. Jim Caron not joining the House of Rosenberg, if you will, to David Rosenberg of Gluskin Sheff. You're instead saying the money's to be made in a tactical spread trade. Explain that to us.
Yeah, so what we're basically saying here is that the market here is rife with many opportunities within the fixed income markets, particularly within the Treasury markets. And one of the areas that we feel the most comfortable with owning is the front end. And we at Morgan Stanley are advising clients that we want to stay closer towards the front end. I would say 5 years and in is where we would feel the most comfortable advising clients to put their money. We argue that if the Fed is going to be on hold for an extended period of time, that's the sector that's going to actually perform the best. And it also has, on a risk-weighted basis, the best risk-weighted returns as we see it.
Matthew, I want you to swing around here. Matthew, the camera guy, come on around here slowly. Don't trip over the computer. And this chart right here, folks, is the 10s, 30s spread, the difference in yield between the 10-year and the 30-year. Jim Caron, it's way out 104 basis points, historically high back a good 18 years. You look for that yield differential to flatten out. Is that about the 30-year bond driving lower yield, or is it about the 10-year yield coming back?
Well, it's mainly right now about the 30-year bond yield probably coming lower. I mean, clearly both could happen. You could have yields rise and 10-year yields go up, and that could flatten the curve. But that seems very unlikely right now, given where we are and given what the Fed's plan is, particularly to buy Treasury securities in the 5 to 10-year sector, as we believe. And we would argue that all yields are coming down, and that the 30-year point being the highest point on them, as you can see in your chart, it's the highest it's been almost on record. It got to the highest it ever had.
Yeah, 120
All right. You've been listening in there to a great interview with Jim Caron of Morgan Stanley.